Hello everyone and welcome back to a new video. My name is John and today we're going to talk about a company that's about to go IPO next week. That's right, it's a company called TT Vision Berhad. It's an ATE provider or an automated test equipment provider based up in Penang. So we're going to talk about the utilization of their IPO proceeds, their financial standing as of today, what are the risks involved if you were to partake in this IPO? And last but not least, I'll conclude with my thoughts of having studied the semicon and E&E industry over the past 6 to 7 years. As a disclaimer, this video is purely for educational purposes only. I'm neither a promoter nor a dealer for this company, and it is neither a buy or sell recommendation. It is purely my honest opinion of what I think this company is, and if you do need license advice, please do speak to a licensed advisor. So first up, their business model. What do? They are a manufacturer of machine vision equipment. So what is machine vision equipment? Think of the days when if you were to manufacture a semiconductor equipment or an electronic device, you would actually require human labor to actually inspect defects on this equipment. Now, in today's world, everything is done through cameras and algorithms using computers, very high-powered computers, and that is the basic nature of a machine vision equipment. They actually capture an image of the device being manufactured, and it will actually spit out to say whether this equipment actually passed the test or it fails the test, and it actually determines the manufacturing yield of any of these clients that they serve actually. So their machine vision equipment are broken down into 4 different sub-segments. The first one is optoelectronic inspection, second solar cell, third discrete and IC inspection, and last but not least vision guided robotic equipment. Now I'll explain the first 3 by their application. So optoelectronics mainly refers to LED, and once I describe one of their major customers to you later, you will actually get it very, very clearly. Second, solar cell, very self-explanatory. All those solar panels that you see on rooftops of buildings or factories or even residential, yeah, they actually have an equipment to test the manufacturing defects of whatever that's being manufactured on those solar cell manufacturing lines. Third, discrete equipment. An example of discrete equipment, if you open up any of your phones or your TV or your DVD recorder, you see those chips with all those legs or interconnects as we call them. Those are examples of discrete components. Last but not least, vision guided robotic equipment is more to help pick and place certain manufacturing lines and to help move all these products from one line to the other. So these are their 4 subsegments. Their principal markets are in China and in Malaysia currently, and their main distribution channel are those 3 that on the right hand side: the LED manufacturers, solar cell manufacturers, and last but not least, discrete component and IC manufacturers. Earlier I mentioned one of their subsegment is a vision guided robotic equipment. This is actually a complementary equipment to either one of these 3 client niches that they serve. They do serve other foreign markets as well, but they are very, very negligible in the bigger scheme of things. For example, South Korea, Philippines, Germany, US, all these collectively is only 3.84% or less than 4% of their total revenue. So it's not that they are not in other markets, but their principal market is in China and Malaysia. So next up, the utilization of proceeds, or how are they going to use the IPO money? A big chunk actually goes to working capital requirements, roughly about 11 million or 38% or 37%, apologies for that. Next up, R&D expenditure, 8 million or roughly 28%. And the next up is actually repayment of bank borrowing, 6 million. And total cash proceeds or amount raised will be roughly about 28.7 million, giving it a market cap of roughly about 159 million. Very small market cap, and hopefully they can grow as big as the other big boys in the ATE space, like the Vitrox and the Pentamasters of this world, the giants. As I'll talk more about this when I do a peer comparison later. So in terms of their financial standing, this is their income statement and also a showcase of their margins. For financial year end 2021, top line of 47 million. gross margins that are about the region of 30s, high 30s to low 40% kind of gross margins. Profit after tax margins is roughly about 17%. Not as as high as what me or Vitrox or Pentamaster used to have during their heydays. If I remember, I was talking about Me Technovation. I was looking at their margins. Net margins, PAT margins was between 20 to 25%. So again, obviously they are starting from a small base, and COVID really hit them hard in 2020. PAT margins was only 6%, and in 2019 they were actually at a loss in terms of net profits. So they've managed to turn around the business. They were actually, prior to this, they were listed on the LEAP market, and they did a voluntary withdrawal from the LEAP market and relisting on the ACE market. So, kudos to Mr. Goon and his team, on just soldiering forward, even though they had a loss in 2019 and 2020. And, hopefully they can actually maintain their GP and actually PAT margins going forward. Because as an ATE provider, your niche or your specialization is the design of your machines and how you system integrate them, rather than so much of a manufacturer of these machines. So by right, margins, if you compare to their peers, is a bit on the low side, to be honest. But hopefully they can turn things around. So next is their major customers. I'm actually covering a bit of their risk profile as well, because we are evaluating whether they are very concentrated on a few major customers. And by the looks of it, comparatively to other IPOs I've covered last year and this year, it's not so bad, because Domino and Opto, having a length of relationship of 2 years, only contribute roughly about 36%. Now, if you remember an IPO of an EMS company I covered before, Betamac, they had a dominant customer that gave them almost 90 or more than 90% of their revenue. And that is really customer concentration risk. Comparatively to TT Vision, I think it's quite well spread out. 30%, 36% is their largest. And more importantly, in an ATE business, customer concentration is very different from that of a manufacturer, EMS manufacturer like Betamac, because they need the consistency of that kind of large production volumes, whereas for an ATE guy, his lead time is anywhere between 3 months to 6 months. The moment the machine goes out, he has to look for a new customer. It's not a huge batch manufacturing, because they are manufacturing the machines rather than the components itself, which entails a larger volume for the product guys, machine guys, quick turnaround, anywhere between 3 months, 6 months. I don't think it's anything more than a year for lead time, because if not, the customers wouldn't be buying machines from them. Yeah, but that is the nature of their business. And also the customer concentration risk isn't as dominant as that of pure play manufacturer like an EMS. So looking at the profile of the major customers, Dominant Opto, in case you guys didn't know, is a main subsidiary of another listed company called DNO Technologies Malaysia, and they're one of the market leaders for automotive LED manufacturing. So this is where TT Vision supplies to the niche of LEDs, inspection equipment. And the next customer in line, Hanwha, Korean company, manufacturing solar cells, and this is where TT Vision supplies the solar cell inspection equipment. Looking at their revenue segmentation, a big chunk of their revenue actually came from the manufacture of machine vision equipment, and the rest were made up by other related products and services, perhaps some maintenance work and all that. Financial year 2021, 91 or 92% of 43.5 million was actually brought in by the manufacturing segment. 3.798% was brought in by the other products and services. So as you can see from at the bottom left of your screen, financial year 2019 to financial year 2021, the product mix of their machine vision actually changed from year to year, if you notice. Solar cell made up the biggest chunk, 57.6 in 2019. However, if you fast forward to 2021, the optoelectronic inspection, hint, Dominant Opto, gave them the biggest chunk in 2021. Therefore, if you recall earlier, I mentioned about customer concentration risk comparatively to an EMS provider compared to an ATE manufacturer. The way we look at the risk is very different because turnaround times are very different. Product changes, obsolescence, even just rejigging or recustomizing certain equipment to fit the customer's need change very, very rapidly. An EMS guy, if you are someone like Betamac who manufactures, let's say, radios for cars or CD players for cars, that kind of product doesn't change rapidly as that of an ATE. And the customization, the less customization, the better it is, because you want to manufacture it at scale. You want all your lines to be as efficient as possible, because every time you customize, you have to turn off the line, customize the thing and run it up again, and that's actually lost in terms of downtime. Therefore, the way we look and categorize ATE players versus EMS or even OSAT players, customer concentration risk is very, very different. So I'm not saying it's good or bad, it's just the different natures of the niches of the business. So looking at the peer comparison, TT Vision serves an additional industry comparatively to their other peers. They serve the solar industry rather than just being concentrated within the semicon. And the other players that they're competing with or being frenemies with are the Mi Technovations and Genetechs of this world. Obviously, the big boy in town is actually Vitrox. Revenue of 600 over million, close to 700 million, whereas TT's Vision is only like 47 to coming to 50 million. So still a long way to catch up to the size of a Vitrox. Even then, I feel that the market is big enough, because let's look specifically at Vitrox. Vitrox started off mainly as a vision inspection ATE player for PCBs. They have maintained that niche, dug very deep, did very well, and they're now starting to expand a little bit more upstream towards wafer inspection and all that. But obviously, their big niche is still PCBs. And PCBs are mainly for the EMS players and all that. So whereas TT Vision, they choose to focus more on, let's say, optoelectronics. So D&O, very optoelectronics, not much PCBs, and solar cell inspection. So I think these different niches help differentiate the different ATE players, because the technical requirements, the experience that you gather, that domain knowledge stays with you, and you can be a player just being the niche, because the industry is so big, right? And I think this is where let's see how TT Vision plays the game. Are they going to stick or go deeper into their niche of optoelectronics and also solar? Or are they going to expand where they see that, maybe I've already saturated my very special niche. So yeah, all the best to them. Hopefully they grow as big as the Pentas and the Vitrox of this world, because we do need a lot of Malaysian champions, especially when we have such a good Silicon Valley in Penang. And with them growing means the industry on its own is also growing. Now looking at the risks, I think customer concentration I've explained earlier, but I want to focus on the angle that they are still dependent on the client's capex spend or their capex cycle. Why is this important? If I draw parallels to the oil and gas industry, all the Malaysian service providers are very dependent on the Petronas capex spend. Because without that capex spend, that means they are not expanding their manufacturing base. And when they're not expanding their manufacturing base or manufacturing lines, there is no potential of TT Vision selling this equipment to inspect the manufactured products. So again, semicon is a very cyclical industry. So if you look all the way up the value chain or the food chain, if the foundries are not spending, therefore the OSATs won't be spending, and therefore, the ATEs will not get a chunk of that spend. Very simple. Secondly, absence of long-term contracts, something that a lot of investors or analysts look for. Where's your recurring income? The nature of the ATE business is there's never such thing as a recurring income. Let's get that clear once and for all. There may be some recurring income from maintenance contracts, but that's about it. It's not going to make up a big chunk of your contracts, okay? Next, I think the risk that is very pertinent to an ATE guy is actually material cost, because 50 to 60% of their COGS is made out of material costs, and I think that is something that will be cyclical. Look at what has happened in 2021 and 2022 with the chip shortage. Costs actually just balloon, so something to watch out for. Next is talent retention. As I mentioned earlier, the value or the specialty of an ATE provider is actually that engineering know-how to customize that solution to their clients. So retaining key management, retaining the talented engineers is actually very, very key. I've spoken to so many CEOs of ATE players within Malaysia. Top on their list, even for the precision engineering guys like UWC or even Kobe or even Wong, top on their list is always talent. Is hard to come by. So talent retention. Last, and I think this list is not exhaustive, but I think these are the 5 main ones that I can think of. Forex. I think if memory serves me correctly, about 40 to 50% of their buying costs is actually denominated in US dollar. Even though they bill mainly in US dollar, especially to the Chinese customers, the struggle is also that their raw material costs, a lot of this equipment that they buy is also pegged to the US dollar. So there's this arbitrage that they constantly need to manage or to hedge. So Forex definitely plays a role as their risk factor as well. So to conclude, ATE players, their growth are very much pegged to the customer as well as the industry cycle. If they are at the bottom of the cycle, customers are not spending, it's very difficult for them to sell more machine vision inspection equipment. Next, I think the relationship with customers is key, because as an ATE provider, you spend a lot of time understanding the customer's requirement and building that into the machines, and also fine-tuning that on the manufacturing line at the customer's facility. Next, I think for the benefit, if they like to see it that way, for TT Vision, they're starting with a very small base, and their advantage is being very niche into opto versus the other big boys who are more focused on machine vision for PCB industries, especially the EMS guys. So I think I like to borrow a phrase from Bruce Greenwald: riches are made in niches. And I think, having that deep understanding of the opto industry may serve to TT Vision's advantage. Last but not least, I think to grow to the size of the Vitrox or the Pentamasters or the Mees of this world, I think management team cohesiveness and retention of talent is very, very key to scale the company. I mean, look at what Vitrox did. Really rewarded their early employees 001, 2, 3, 4. A lot of them are already multi-millionaire by today's standards. Most of them are still as the top retained shareholding, and they are the top 30 shareholders of Vitrox. And I think by sharing equity, I think that's one method of retaining that talent and management team cohesiveness. You don't want infighting and people leaving that hampers the scalability of a company like this. So those are my thoughts on TT Vision. I hope you enjoy content like this. If you do, subscribe to the channel, give it a like so that the algorithm can spread it to more like-minded individuals like you, and do hit that notification bell so you know new videos are out. I'll see you guys in the next video.